Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, November 17th, 2025. Hope everyone had a great weekend. So, as always, we'll start with the executive summary from today's leadoff morning note. So, let's hop right in. Today's key macro question is: will this week's key macro and micro data derail asset markets? The short answer is they may, given the near-term headwinds being signaled by our macro weather model. In terms of the analytical nuance, S&P 500 futures were flat after erasing earlier gains of 0.7%, as sentiment weakened ahead of a pivotal week that features NVIDIA earnings and the long-delayed release of key economic data. Earnings from NVIDIA on Wednesday, Home Depot and Lowe's on Tuesday, Target on Wednesday, Walmart on Thursday will serve as critical readouts on the health of the AI CapEx cycle, as well as on the K-shaped household consumption cycle. The September jobs report is expected to be released on Thursday. The Fed will release minutes from its October 28th through 29th meeting on Wednesday. The data are expected to further support the directionally hawkish Fed pivot being priced into asset markets, specifically the minutes, the October minutes. After a 43-day shutdown, U.S. federal government operations finally resumed late last week. The Federal Reserve and other policymakers are still operating with incomplete economic visibility, and the disruption has already complicated next month's decision on rates with an FOMC decision on Wednesday, December 10th. Mounting anxiety over a possible hawkish tilt by the Fed has driven traders to slash December rate cut odds to below 50%, as several officials caution that additional easing is far from guaranteed. Elsewhere, Amazon's plans to raise about $12 billion through a U.S. dollar-denominated corporate bond sale, its first high-grade U.S. dollar issuance in nearly 3 years. The 40-year tranche is expected to price around 115 basis points above comparable treasuries. The shift from funding CapEx primarily with cash to a mix of cash and debt has received a lukewarm response from markets. Our analysis of U.S. private non-financial sector balance sheets suggests the corporate credit cycle has plenty of scope to run from today's starting point of low leverage and low debt service ratios. Whether the stock market rewards incremental leverage remains to be seen. As always, members of our global investor community can trust that our institutional-grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying on fundamental research alone. Transitioning to our 42 micro dashboard, as always, we'll wrap up with a question from our community. This one's regarding Bitcoin. So it reads, as a new member, I would like to hear if you could provide a 3-month outlook for Bitcoin. As a Danish resident, I am not allowed to invest in many of the U.S. Bitcoin ETFs because of taxation in Denmark. So instead, I've made my exposure to Bitcoin in some of the Bitcoin miners. The last month, they have been hit hard, but I have held on because of expectations of rate cuts and new liquidity in the market. I know you don't have a crystal ball, but it would be nice to have your take on where you see BTC from here. I think it's where. Is it too late to exit the trade, or have I been riding this move so long that it's more safe to stay and get full exposure to a no uptrend? 3 days membership is the reason why I didn't get your recommendation to exit BTC in time. Have a nice weekend. So excellent question. This is a phenomenal question because it gives us an opportunity to educate the general investing public regarding the difference between type 1 and type 2 errors, which is something we've been focusing on in our research in the recent weeks. So the type 1 error is when you have for example, a system like KISS or Dr. Mo that generates a risk management system to, let's say, take down risk as it has done in Bitcoin, over the past month or so. If a type 1 error is, an error that essentially does not get rewarded by the market. So essentially, we sold Bitcoin, but it starts to rally, or you buy Bitcoin and it starts to go down. Those are the types of errors that, try to align your portfolio with the right side of market risk based on, momentum, and for whatever's organizing your risk management process. We obviously have, our proven quantitative techniques, but, others might have their own. So that's a type 1 error. It's a type 1 error that isn't an error that isn't rewarded by the market. A type 2 error, which is what the question is sort of underlying, is, hey, can I ignore the signal that is trying to, essentially truncate type 2 error by staying long an asset that is very effectively crashing because I think it's too late? And so a type 1 error or type 2 error is sort of rejecting what's happening in the market because you believe what's happening in the market is going to change in favor of your legacy positioning. Type 1 error is, I'm going to go with the market because I think it should change my legacy positioning because the market is smarter than me. Type 2 error suggests I'm smarter than the market, Therefore, I'm going to ignore the developing market signals and stay long an asset that is very clearly crashing and could easily crash further from here. And so that's kind of the key takeaway is you have to make a choice as an investor. You have to decide whether you want to expose your portfolio to type 1 or type 2 errors. So kind of just looking at this, let me find a place to draw. Yeah, this is a good place as any to draw on in terms of, what type 1, the difference between type 1 and type 2 errors. So if you drew a distribution of returns in your portfolio and kind of divided it up into 4 quantiles, and we can ignore the positive returns for now. But type 1 errors sort of live here, in the kind of the small to medium size declines that you experience in your portfolio as a function of type 1 errors. Type 2 errors live here, which are the more, the bigger declines that you experience in your portfolio as a function of ignoring developing market risk. And so type 1 errors, Kiss and Dr. Mo and the institutional grade risk management overlays that are being employed by the top buy side institutions in the world, many of whom are our clients, and those are the folks that I consult with on a regular basis in our Porta Pro service, we are all organized to eliminate type 2 errors from our portfolio so that the errors that we do experience in our portfolio are type 1 in nature. Again, trying to stay on the right side of market risk. You may not be rewarded by trying to stay on the right side of market risk, but ultimately, any system that is trying to get you to stay on the right side of market risk will inevitably truncate your trades. They'll stop you out of trades at a smaller price to pay than type 2 errors, which is I'm smarter than the market, and therefore I'm going to stay long a crashing asset, or I'm going to stay short an asset that's rallying because I assume, or my investment process, my fundamental research process is telling me to stay long in the face of a crashing market or to stay short in the face of a recovering market because I think I'm smarter than the market. I don't know of any buy-side firms charging 2 and 20 or more, 3 and 30, which is what the best funds charge. I don't know of any buy-side firms that subject themselves consistently to type 2 errors. You can't. The institutional finance has evolved tremendously since I started my career nearly 2 decades ago. There was a lot more funds set up to have experienced type 2 errors in their investment process, but the assets under management has clearly gone from funds that are organized to have type 2 errors to funds that have much more sophisticated and thoughtful risk management processes that expose their portfolios to type 1 errors, which are, again, smaller in nature. They may sometimes be more frequent. If you have some chop, going back and forth between signals. But the reality is chop is way better than blowing up your portfolio. You want to live in here with regards to the errors that you experience in your portfolio. You do not want to live in the type 2 error bucket because the type 2 error bucket exposes your portfolio to an unlimited amount of risk. Your shorts can go to zero, your loans could go to zero, obviously, and get bankrupted, and your shorts could grow infinitely. And so that's the kind of error you want to eliminate as an investor. And for those of you listening to me as an investor and you think you're smart enough, or I'm smart enough, or anybody on Wall Street is smart enough to never have any error in their portfolio, i.e. 100% of their trades make money, that's an absurd expectation. And so as an investor, you have to recognize how absurd it is to realize to expect that you're never going to have any error with regards to your risk management process or any process that you use to generate trade ideas, both opening trades and closing trades. And so once you are smart enough as an investor and experienced enough as an investor, which in my opinion doesn't require very much common sense, to realize that you're going to have error in your process, you then have to decide, how do you want to organize your risk management process? Do you want to organize your risk management process so that you only have type 1 errors? Or do you want to organize your risk management process so that you primarily have type 2 errors? It's a choice. You have to make a choice because you're going to have error. It's how do you deal with error as an investor that determines your success over multiple full market cycles. You will have a lot more success as an investor over multiple full market cycles by organizing your risk management process to only have type 1 errors, which is what Kiss and Dr. Mo do, as opposed to what going back to the question is essentially asking, hey, can I stay long a crashing asset because I missed the signal? I didn't subscribe soon enough and I missed the signal. And this is another thing I'll say. If you're out there listening to me talking these macro minutes on a regular basis, why would you wait until an asset that you're long crashes before you subscribe? You have an opportunity to click the button right now and subscribe to 42 Macro right now. We've been telling you very explicitly for the past month that the macro weather is changing. It used to be incredibly bullish. We've been pounding the table on Paradigm C. You got to buy since May 3rd. We've been saying that since May 3rd. But since October, I'd say mid-October, we've been saying, hey, no, the macro weather is evolving in a manner, the distribution of probable economic, policy and market outcomes is evolving in a manner, i.e., the whole entire distribution is shifting left. It used to be positively skewed return distribution. Now we have this Gaussian skewed return distribution, and that leftward shift in the shape and size and scope of the distribution is negative for asset markets. So why would you sit here and wait until the assets that you're long start crashing and then go, well, I missed the signal from Kiss and Dr. Mo to get out a month ago and subscribe a month later? That's not a smart way to invest if you want to improve the results that you're experiencing in your portfolio. So hopefully this was a very helpful discussion regarding type 1 versus type 2 errors. Kiss and Dr. Mo organize, and Kiss and Dr. Mo organize the same way that the funds that are charging 3 and 30 across global Wall Street are organized, which is to only expose themselves to type 1 errors, which are the types of errors that you experience when you're constantly trying to, not constantly, because we don't trade much in Kiss and Dr. Mo, but when you're trying to organize your process to stay on the right side of market risk, which is what the smart folks, which is the people who are having the best results are doing, as opposed to organizing your process to stay on the right side of your own fundamental research views, which exposes you to an unlimited amount of risk from a left tail perspective. So we're wrapping up there. Darius still here, presenting our macro minute for Monday, November 17th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Have a great week. Cheers.